Welcome back to the channel. As always, if you are copy trading, you are an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to speak today about a company called CH Robinson Worldwide, ticker CHRW. Why am I looking at this company right now? Well, as of today, that's the 6th of July 2026, there has been a rotation stepping away from semiconductors and tech for a few days now, although it's reverting a little bit today. But the theme of that rotation is that there is an ongoing debate as to whether the capex in AI infrastructure is justified based on the productivity acquired by companies. And a lot of the capital that has flown out of this end of the market has been rotating to the real economy, right? Real businesses um, and operations, enterprises that are the backbone of everyday consumer operations. So this one stands out because one, it is definitely very much in tune with that kind of theme. Two, it is going to benefit from a tailwind, which is the declining prices of oil following the Iran war, but also the company itself is positioned to become the master of its own sector. You see, in terms of what this company does, they are a freight middleman. They don't own track. They connect thousands of companies that need goods to be moved with about 450,000 trucking firms. So they handle 37 million shipments per year. And they make money on the spread. So on every $100 that a customer pays, roughly 15 to 16 they keep, and the rest goes to the truck. So the stock, as of now, is trading at just under 190, and the company is worth 22 billion, which is a little bit larger than we tend to look for. But in terms of what the company is trading, right, the ratings of the analyst, and the upside that we have going all the way around the low 200s is definitely there. If we look at the estimates, we can see that sales are turning around and are going to be increasing, and so are the benefits, the EPS, earnings per share. So there is a truth that fundamentally drives this stock in the first place. Trucks are becoming scarce. For 4 years, there were too many trucks. So if you remember, we were getting out of COVID. A lot of people were buying goods to be delivered to their homes and doing home renovations and all kind of purchasing all kinds of goods. So prices only fell for this kind of freight. Small truckers ran below their own cost per mile for over 2 years uh, and went bust. So about 260 firms per week were literally going bust every week. So that's about 100,000 operators gone. In addition to that, new driver rules like licensing and language requirements are removing more truckers from the market. And the result of that is that day-to-day spot trucking prices jumped from about $2 per mile in August to about 280 at the moment. So that's pretty big rise in 4 years. So truckers are now refusing cheap contracted loads, and the highest rejection rate since 2022. That's what's been happening. So the scarcity at first hurts the middleman, and that's probably what you can see, right? The behavior of the stock was flat and in some cases negative in previous years, but is now significantly recovered because the market sees that One, the macro for the sector is improving indeed, but two, the company is positioned to remain the top, to become the top player essentially. So about 70% of their truckload is fixed on annual prices. And when truck costs spike, as they did in Q1, about 20%, the selling prices are locked, so the spread gets crushed. In past cycles, Robinson lost about 1.5 to 3 percentage points of margin. At this exact moment, roughly 45 to 90 million of profit per quarter. But this time it lost zero. So margin held at 14.6%, and operating margin actually rose 3.1 points, and earnings grew in the worst quarter of the transition. So there are three profit engines going forward, right? That I believe will drive the stock forward. First of all, their contracts reset higher, and that is worth about 80 cents to $1.60 per share. With trackers projecting 14% of loads, history says annual contract prices rise between 8 and 15% within 3 to 4 months. And Robinson just locked in a strong contract season at those better prices, effective in the second half of the year. So every 1 percentage point of margin the company recovers is about $120 million of gross profit. So that's how we arrive at the 80 cents per share. This is the bridge from this year $6.15 EPS to the 7.34 that analysts expect. The second profit engine is the cost fall on a schedule. So this alone funds the $6 per share with zero market help. The company headcount is down 12% year on year, while volumes grew. A price quote that took 17 to 20 minutes now takes 32 seconds. And management guarantees that $6 of earnings this year, assuming the freight market does nothing, so basically stays flat. But analysts sit at just $6.15, barely 2.5% above that worst case, from a team that has beaten expectations 4 quarters by running at 7 to 10%. So by simply repeating that pattern, we are looking at a scenario where the earnings will be higher than what's already baked in. And to illustrate the point, you see over here how since mid-2024, the EPS expectations have been exceeded consistently. More so, the price day, the 1 day price reaction has been overall pretty positive. And last but not least is the main point that underpins the whole thesis, right? So the competitors are being wiped out. In May, the Supreme Court ruling made every broker suable for accidents caused by trucks they hire. Robinson absorbs the insurance and vetting costs trivially. For thousands of tiny brokers, it's existential, really. That cost can put them out of business. But Robinson is already buying the pieces with a $2 billion buyback behind it, right? And that's 9% of the whole company over 3 years. On top of that, freight volumes have fallen for 40 straight months, but the gap just narrowed to minus 1.2%, and that is the best in 18 months. And it's projected to turn positive by the second half. So in other words, we are also seeing a turnaround in the sector, which should aid the performance of the company, right? Because the fundamentals are just healthier. So none of those $6 per share assumes any of that. And extra volume lands on an automated cost base at near pure profit. In terms of catalysts, of course, we have one coming at the end of July, so that's not so far from here. But the reason why I think it's good timing at the moment is because prior to that, in the next 2, 3 weeks, we will also see their competitor results, and that could drive the stock farther up, leading to a major move uh, into their earnings report. Which, by the way, the options as of now show an implied volatility of 40%. So that is a decent move for a stock that is trading at $190. As well, we have the monthly freight data released in mid-July and mid-August. So all that creates a significant dollar value in terms of upside that we can see over the next few weeks. So in summary, what the company sells is repricing up 8 to 15%. What it costs to run it is falling on a schedule. Its competition just got regulated and is getting wiped out. And we have plenty of near-term catalysts to manifest all those fundamentals. The main risk is that, at the current valuation that we see in the market, nearly 30 times, it might not leave much room. It might be a little bit priced for perfection. But aside from that, I think the fundamentals are the right place to be right now because the company and the sector that it's operating in is coming back. Hope you enjoyed the video. See you soon.